Almost 20% of the FDIC insurance fund is wiped out because of Silicon Valley Bank and Signature Bank. Yeah. And how are they going to pay that back? Because they're gone. Where does this money come from? It's actually a good article on MSN. It was Market Watch. I was surprised this. I don't know if it's on Market Watch, but MSN. I was surprised to see this. Failed banks struck a $22.5 billion blow to the deposit insurance fund. Who's going to pay the price? Who are these clowns? Are these the people in the failed banks? Well, see them in jail, man. I mean, you're stealing from the freaking American people. You can't do that. Allegedly. All right, let's keep going. The collapse of Silicon Valley Bank is expected to cost the FDIC $20 billion, and the Signature Bank, that Barney Frank was a member of the board, another $2.5 billion. The bulk of these costs related to covering deposits that exceed the FDIC insurance of $250,000. The FDIC will propose a special assessment on banks to repay the insurance fund losses. So we're going to tax the socialism, babes. Socialism, baby. Tax the producers to allow. It always is the same thing. We socialize the risk and we privatize the profits. The Silicon Valley Bank, all those guys. Did I show you this? Hold on a sec. Check this out. Yeah, on my locals page, joshscanlon.locals.com. We're going live, by the way, today at 4 p.m. So be there or be square. And you don't want to be square, do you? You want to be a circle. So join me on locals, 4 p.m. Eastern time. Silicon Valley Bank increased loans to its insiders before its collapse. Look at that. I mean, so here we are, putting along, and then right here, the 2 quarters before it collapsed. I mean, look, that's a doubling of the loans, and that's I don't even know what that is, quadrupling. So where did that money go? They just, you don't have to pay it back? What the hell? The increase in a special assessment comes amid a longer-term debate predating this year's bank failures about how to shore up the fund. The fund, which held just over $128 billion in 2022, so that's where I got my 20%, 17.1% to be precise. So they got $128 billion in FDIC trust fund, and they lost $22.5 billion. That's a 17% decline, dude. Gone, just like that. And that the deposit insurance fund is funded mainly through quarterly fees paid by insured banks. And any changes those fees can stir controversy. Banking industry groups last year opposed the FDIC board to raise the deposit insurance funds by only 2 basis points. Now industry players are raising concerns about how the special assessment tied to banks' failures will be allocated to the banks. The idea is that all banks now should have to pay? That is a really difficult pill to swallow, says some lady who heads the Independent Community Bankers of America. Our banks aren't the one who took the risk, and we didn't get the profits. We didn't privatize the profits, but we're socializing the risk. This is freaking commie crap, dude, and it always fails. Lawmakers have raised similar concerns. Can you tell me how it's possible when the special assessment fee process is completed that my community bankers aren't going to wind up disproportionately paying for the mistakes of the biggest institutions in the country? The silly head of the FDIC responded that the proposal will be put out for public comment. Where did this guy come in? Gruening from FDIC commissioner. Let's take a look at this guy. Did Sniffy Joe put him in? What's this guy's name here? 1 second. Right there. Martin Grupig. Let's look this guy up. Let's check this out. This whole thing's such a clown show. He was just sworn in on January of 2023, but he's been on the FDIC board since 2005. Served as vice chairman 2005 to 11, and he worked for Paul Sarbanes. Remember Sox? Sarbanes-Oxley? Clown show. Big lib. Oh yeah, international finance. He worked. I mean, just a government bureaucrat. He's never done anything. He's never freaking dug a ditch. This guy's in charge of our banking institutions. Like, I got no antipathy towards this guy, but we're led by fools, dude. There's no other way around it. And look at this guy. What have you ever done there, Grunberg? Whatever the hell your name is. What's this guy's name? Grunberg. You ever done anything? Oh, yeah, he's got a law degree from Case Western and an BA from school from Princeton. Oh my goodness. The whole thing's collapsing. Let's see here. Some industry experts also say consumers will ultimately pay the price. Exactly. as banks cut back on services or pass costs on to customers in the form of less favorable rates or additional fees. At the end of 2022, the Fed's reserve ratio is 1.27%. The losses tied to the stupid banks put a major dent in that reserve ratio, pushing it way below the 1.3% target. We're going to have a lot of pushback in the industry as how fast the fund should be pushed back up. Yep. The insurance fund's estimated cost out of the recent banks' failures also outweigh the total amount the funds collected from bank assessments. The fund's assessment revenue is only $8.3 billion in 2022. And we just lost $22 billion. In a joint statement, the ABA, the American Bankers Association, trust me, these are not our friends, and four other industry groups called the increase a preemptive strike against a non-existent threat, although the rate increase may have looked small in percentage terms, it's significant in dollar terms for many community banks. Yep. So I just read right quick, too, about USA. They're laying off a bunch of people. Their loan volume is way down. This is USA Bank, all right? So they're no longer really in investments anymore, so it's bank and insurance. They laid off, what was it? They just laid off a couple hundred, like 700 people or something like that. If I can find it. Hold on a second. I'll show you. Stay with me, friends. Stay with me. Do not run away while I'm looking this up. Yeah, USA to lay off 475 employees to economic downturn. That was just as of yesterday. And they laid off a bunch of people earlier this year than last year, too. USA says will lay off roughly 1% of its workforce. Yep, exactly. I'll probably do another video on that. They talked about the bank right here, too. USA Bank cut more than 90 roles in April, and then an unknown number of employees in the triple digits in August of last year, because USA Bank projected a 34% drop in real estate loans. They had staff in place to facilitate 38,000. They only had 25,000 matriculating. Yeah, man. That's so now margins are being squeezed or laying off. Let's throw another fee on top of them to maintain the FDIC. Yeah, what's that going to do for me, your old buddy Josh at USA Bank, or your bank? It doesn't matter. What's that going to do? Look, FDIC insurance coverage is like Medicare. It's only there when the dollars are there, and there's no dollars there. So what do? You got flee. You can't flee. You can do whatever you want, but you can flee. You say I put all my money in a freaking cold storage. No, but the whole thing is just a joke, dude. Just recognize that. Recognize there's not strong coverage in any of this stuff. It's gonna be covered until it's not covered. Then you're like, okay. And so just think about it. They always gripe about the unbanked. There's none of brown and black people getting bank accounts because the fees are too high. That's what they always say. I've worked in banking for many years, and I hate that crap. That's the CRA point, whatever it is, Community Reinvestment Act. We got to get more brown and black people, indigenous people, BIPOCs, and who knows, whatever, 57 flavors else. So now what we're going to do here, so they want banks not to have any fees, and yet we're going to have to charge bank fees to make the FDIC more strong. Well, where does that come from? At some point, the unicorn farts got to come to reality here. And I don't know what it's going to be or when, but it's not going to be. So real quick, reading this, I just got this book, freaking fantastic so far, The Price of Time. Easy money is the great cause of overborrowing. When an investor thinks he can make 100% per annum by borrowing at 6%, he will be tempted to borrow and to invest and to speculate with borrowed money. Yep, and then James Grant. There's nothing so unstable as a stabilized price level. The easy money days are over, and the speculation is going to come to us. And we want the higher interest rates. We want this. This is good. That means we don't have to partake in speculation. But there's going to be a coming to Jesus moment here, man. Be prepared. I'd love to hear your thoughts. See ya.